Hi, and welcome to Random Rogers Big Picture for the week of May 31st. One thing on the agenda this week, I'm going to answer a viewer mail. Mr. Richard Fader from Fort Lee, New Jersey writes in to ask about thematic investing and trigger points that I use to exit a theme. Well, that's a good question. There are no trigger points. I don't think there can be trigger points. If you're really investing in my idea of a theme, the way I use the word theme, which is a kind of a long-term, slow-moving tanker. For example, the ascendancy of a middle class in China. How are you going to? You can pick a stock for that, and how are you going to get that wrong? In a couple of months. It's the ascendancy of however many 100 million people that would be that will ultimately comprise the middle class. So to my way of thinking, trigger point doesn't work. I think the way that you have to think about it is not so much in terms of trigger point, but in terms of, following the dynamics of the theme and maybe realizing that there's some aspect of the theme that causes you to believe maybe you're not on the right track. Maybe an example I can give of this, and I don't think it's a great example because it was just, my own thing. I had a little bit of exposure to India. It was not an across-the-board thing, but for, I would say, quite a few clients for a while. I captured it through a closed-end fund, and for a while it went up. There was a period there, this will come again, maybe we'll look back on now and saying this, but there was a period where, just about any emerging market, anything, it was like shooting ducks in a barrel, or do you shoot fish in a barrel, or is it monkeys? Whatever it is you shoot in a barrel, that's what it was like because everything was going up. So I don't know that I necessarily picked a great country, but the fund I had went up a whole bunch, was paying out enormous dividends / capital gain type stuff, which in an IRA account is not a bad thing. I followed things as best as I could, which is to say I do spend quite a bit of time, that's all I do with my day, is follow these things. And as time went on, and I'm watching what's going on there, or trying to watch and watching what's going on in China, it seems like an obvious compare and contrast. Somehow I just became disenchanted. I felt like something wasn't quite right with India when compared to China or some of these other places that I talk about. I don't necessarily know that my getting out of India was right versus wrong. I'm glad that I'm still not in the country. I didn't want the exposure anymore. So it was right for me, which does nothing to vindicate or justify the decision. Thinking about another theme. Okay, so how about Norway? Okay, well, so a big thing there is oil. I can't envision a scenario where there isn't upward pressure on the price of oil for a long time. That even just that potential means good things for Norway. They save money. They're incredibly responsible fiscally. They've got a $300 and something billion sovereign wealth fund. You know the whole story. I've read it to you before. I'm not going to eat up time with that. At some point, if oil somehow, defies what seems like the obvious thing to me, goes down to 30, stays there forever, they start to burn through the sovereign wealth fund that they have, that is going to represent a change of some sort. They may, were they to burn through it, it might be, smart to do, or it might not be smart, but the notion of it no longer being a responsible surplus country, all of those things I've been writing about, that would be a reason. There's no trigger point. I wouldn't set an objective trigger point for that, but that would be a reason to consider, backing out of the position. As an example, China. Okay, that's actually a better example. No convincing me China doesn't become the straw that stirs the drink. There we go. No convincing me otherwise. However, and back up a little bit. I owned China through the oil companies, first PetroChina way back, and then I switched to Sinopec for a while, sold Sinopec in June of 2007, which, as I've disclosed many times before, was yeah, about 5 or 6 months early, but for some folks it was a triple, and I took the trade. But sold it early, had no position in China for a long time. Then in the summer of 2008, I'm pretty sure it was the summer of 2008, after a 60% decline, I went back in. I never, emotionally speaking, left China. I knew that I would be back in it at some point, and I laid out a strategy of what that would be, which would be the market is likely to cut in half, I felt, and you can look this up. I wrote about it. I think the market might cut in half, and then if it does, I think it might overshoot something like 60%. At down 60, I got back in. It ended up going to down 70. So again, early getting in. But there's kind of a quasi-objective in that I assessed the situation and made a determination of what I thought was best, and then I stuck to it. I made that plan long before anything happened, and then I just stuck to it. Much easier to oh shoot, it's down 50%. Well, what should I do? Trying to work in that way, I think, is very difficult, which is why I don't do it. It makes the task harder. So it was actually not a question from Mr. Richard Fader in Fort Lee, New Jersey, but Jeff in Milan, Italy. Jeff, hope that begins to answer the question. That's about it. Have a good weekend. By the way, I don't know if you can see her, but I've been petting Tater throughout this. I don't have not developing a nervous twitch. Have a good weekend.